Okay, let's start. Welcome, everybody. It's a longish webinar. Typically, we do just under an hour, but today we have a lot to cover. 13 countries, macroeconomic outlook, and 5 or 6 asset class, from commodities to rates to FX to credit. We even have our crypto specialist there, just in case anybody has questions on that. As you can see, that there is a QR code on the very first screen, so we will happily take your questions during the course of this presentation. Scan this or go to dbs.pigeonhole.at, password DBSGR 2026. If you miss it, don't worry, we'll bring this over to you over and over again. I will now show you another QR code. On the left-hand side, you can see the cover page of our annual outlook. It's a picture I took earlier this year when I was in Mumbai, India. Although it doesn't show you two different paths, we were thinking, validly from our team was suggested to me, even in this picture, you can course to the left or the right. So you can go southwest or northwest. Separate paths. Why is that the title for this year? It's because we think that while the year has turned out to be better than expected, we do have makings of divergence and decoupling, something that probably was unleashed a decade ago, or perhaps even earlier than that in the aftermath of the global financial crisis. But with the second term of Donald Trump, we feel those trends are getting accentuated. We are not talking about a world that is divorcing from each other. Whether it is China-US or ASEAN-China or India-China, none of these dynamics can end up in a divorce. It is not possible in a world that we live in with the interconnectedness that exists to have decoupling. But could we have separate standards for technology? Could we have separate ways of running businesses? Separate rules for settling trade? Yes, quite likely, especially if the largest economy in the world turns increasingly inward and chooses to write its own rule for everybody else to do business with it. The world will probably have no choice but to write those rules and accept those agreements with the US to do business with the US. But for the rest of the world, it's a whole different story. The old order, if you will, of globalization, of minimal barriers of trade for goods and services, I think will continue for the rest of the world. That is the essence of the separate path point, and our introductory slides will touch on that. The report has been launched a few minutes ago. The QR code is on the screen. You can download it also by just going to dbs.com. It's featured prominently in just about every single research portal that we have, Insights Direct or DBS corporate page or DBS private bank page. It's all there. That's the QR code. Feel free to download and read the report. But for the next hour or so, maybe for the next 80 minutes, bear with us and try to see what the essence of this report is. The format is the following. I will go over the global outlook briefly. After me, Moji, our China chief economist, will talk about China, maybe also touch a little bit on Hong Kong. Well, and then Eugene Liao will come in to talk about rates. Philip Wee will cap it off with currencies. There will be a bit of time between currencies and Q&A when I will ask some of our colleagues who are not in this webinar right now but have dialed in to talk a bit about India, Taiwan, Singapore, and also some other asset classes beyond rates and FX. Yang Chang will talk about credit in particular, but perhaps also digital currencies or maybe some other FX stuff. And then we will take your question and answers. So here we go. See, the first part has very little to do with 2026, but more of an illustration of the broader global economic trends that we're seeing. When we think in purchasing power parity terms, China is already the largest economy in the world, and India is rising quite rapidly. And by the end of this decade, in PPP terms, these two countries together will make a third of the global economy. This is like the way it used to be 300 years ago. Then colonialism, many setbacks, poor experiments with different direction of economy, everything set China and India back, but they're in a very big way, growing robustly now and are becoming an increasingly strident part of the global economic dynamic. Most of the demand for the world's commodities come from China and India. Most of the world's manufacturing is done in China, and the capital and talent of China and India permeate every single consequential economic and technological node of the world. We show this chart to start by pointing out that even if China and the Indians, the Chinese and the Indians are being pushed by the Americans to change the way of doing business, it is not being done by the Americans in a major position of leverage or strength. I think that is probably something that happens when you sit in the US and look at the $30 trillion plus US GDP, and you feel that compared to China's 15 trillion or India's 4 or 5 trillion, you're much, much bigger. But I think that gives one a false sense of leverage and strength. as we have seen through the course of this year, U.S. cannot bend India to its will. U.S. cannot bend China to its will. And because these countries are consequential and increasingly important, and the PPP-based GDP is, I think, the best way of underscoring their emergence in the global economic landscape. When we look at the key issue of 2025 and perhaps also 2026 is Donald Trump's obsession with trying to look at the world through the lens of trade balances. Well, you could argue that the US is succeeding. It is bringing down its trade deficit vis-a-vis China. We actually project just about $200 billion, so less than 1% of GDP of the US worth of trade deficit between China and the US this year. But what does it really mean? Does it really mean that the US is reducing its dependencies on imports? Because isn't that the whole point, that reduce dependency on import, not just from China, but from the rest of the world, force the world to invest in the US, force the world to move manufacturing to America? Well, from that perspective, we have a long ways to go, because when you look at the overall trade deficit of the US, it is on course to worsen this year, not improve. So the US, on paper, may be buying less from China, but that doesn't necessarily mean China is selling less. China is actually exporting more this year than they did the previous years, just less to the US. And as far as the whole world is concerned, their trade with the US continues unabated, despite all the tariff-related consternation and disruption. And the US consumers' appetite to consume a lot of imported product remains voracious. When we look at the same question about what's happening between the China and the Chinese and the U.S. trade relationship, I think this chart is evocative. It shows to you that over the last decade, China's exports to the U.S. have basically become stagnant, starting with the trade war with Trump 1.0, and then no further relaxation of trade-related restrictions under Biden, and further exacerbation of the trade relationship under Trump 2.0. China has basically not been able to grow its market share in the US, and by and large, many Chinese companies have lost access to the US. So in real terms, China's exports are down substantially. In nominal terms, on a year-on-year basis, exports are down about 20%. Even on the 10-year basis, there has been no change in China's exports to the US. But during that same time, China's exports to the rest of the world has gone up by 81%. So the overall trade dynamic in the world, that the world wants to consume things that are made in China, remains unimpeded, unabated. And I would argue that some of the stuff that is made in China is making its way to the US. That is not reflected on this chart. It's just transshipment and various other ways of adding value and moving things around. I want to sort of move on to the core acronym that we have been sort of trying to popularize through the course of this year. We came up with this acronym in April when reciprocal tariffs were announced, and our view is that we need to think about the world in terms of trade being done outside the US and trade being done with the US. It's a play on POTUS, of course. So TOTUS was about trade, that the world will continue to find ways to do deals with each other, whether it is RCEP or CPTPP, or within the ASEAN-India relationship, or FTA between India and Europe. There will be many ways of figuring out ways of doing trade, even while the US starts keeping barriers and puts up all sorts of restrictions of doing trade with the US. So the trade outside the US, in our view, was important consideration. After all, 89% of global trade, 75% of global GDP reside outside the US. But as the year progressed, we realized that with the visa restrictions that the US was imposing, the way it was sort of defunding university research, the way it was making the US somewhat of a less welcome destination for foreigners, that the T in TOTUS can stand for a whole bunch of other things. Let's talk about the three before I talk about technology. With respect to talent, with professors in America, especially with the foreign passports not feeling very welcome, they are looking around to teach in universities in the UK, Europe, China, Singapore, elsewhere, Canada. And in terms of travel and tourism, a lot of people are a bit nervous about going to the US. They have been seeing what happens at US immigration areas and so on. So more tourist dollars for the rest of the world. And same thing with events and issues related to movement of people and so on. Then there's the issue of technology. We have been discussing this repeatedly, and I think Mo in her slides will also talk about this, which is that China's technology stack keeps on getting deeper and more consequential, and hence the old paradigm that if you don't have access to Western technology, you are at risk of obsolescence is fading. You can run a technology stack, whether it is around AI or advanced communications or next generation research on life sciences with Chinese tech and with collaboration as far as Chinese labs are concerned. If you go to the World Intellectual Property Database, WIPO, what you will see is that they characterize tech clusters around the world based on patents coming out of various research areas and collaborations that various research areas do with other research areas. What do you see there? If I ask people attending this call, if I ask my team members, most of them will say that Silicon Valley is the most consequential tech cluster in the world. That is not correct. Guangdong Shenzhen is the most consequential tech cluster in the world, according to the WIPO database. You can also see in that database, in the top 10 tech clusters in the world, 4 or 5 come from China alone, and then there's also Japan. So the US is actually not that critical. It is important, but not that important. As tech clusters start to be recognized as not belonging only to the US, tech standards will also get settled outside the US to a very large extent. If you are in a developing country and you're thinking about 6G, would you necessarily do a deal with an American company or a Chinese company based on national security considerations, or how quickly the 6G coming from China is being commercialized and operationalized, and the cost competitiveness that the Chinese are supplying would be a part of your consideration? I think increasingly it'll be the latter. On the security matters, I think we can all safely say we just assume no matter what we run, the Americans are listening to us and the Chinese are watching us, or the Chinese are listening to us and the Americans are watching us. So I think from a national security perspective, that argument doesn't work that well anymore. So T of TOTA stands for tech, trade, talent, travel, tourism, and beyond. If you think of any other T's, do let us know. Let's talk a little bit about our forecast. After all, this is an outlook publication, not just about the long term, but also what is happening in the 1 year horizon. We are looking at only marginal softening of growth. We thought 2025 was going to be a terrible year in terms of growth and investment because of the uncertainty unleashed by trade war. It's been an amazing stress test, and I think the region has passed it very well. Growth did not suffer majorly, and we can even see in the US, despite all the issues related to immigration tightness and the shock coming from trade, life sort of goes on. American consumers' consumption appetite, as you saw in the trade deficit number, and in a variety of metrics from retail sales, looks undiminished. Going into 2026, there is concern about labor market weakening. Fair enough. We will keep an eye on that. There is concern about Fed and QE coming back and what it means. But by and large, we think that the investment hypothesis around the US economy, largely around the AI and energy-related investment, remains intact and will carry momentum into 2026 and beyond. Global growth in general, unless there's a huge financial sector calamity, will remain more or less at the same rate as this year. And that applies also to the ASEAN 5 economies, which have underpinning of strong FDI as we speak, particularly in Singapore, Malaysia, and Vietnam. When we look at country-by-country growth forecast, we are looking at a gradual slowdown in China, but this is not a cyclical observation. This is a structural observation, and the country becomes bigger as it gets burdened by demographic headwinds. It will slow its growth rate, but it is a massive economy, almost heading in the direction of the US in terms of its heft. Expecting it to grow in EM rates is simply not reasonable, and it has its headwinds coming from property sector and others, which Mo will touch upon. India has a bit of a cyclical slowdown. We are not going to call it a structural slowdown, but maybe some structural measures are needed. The authorities have taken some steps this year in terms of cutting taxes on the income side and the sales side. I will ask Radhika to elaborate on that a bit later. Indonesia is one disappointing story. I think we should table the Indonesia discussion till we release the Indonesia annual outlook. Lots to mull over. I'm not particularly comfortable where Indonesia is heading, but Radhika, who also writes on Indonesia, might have different views. We'll let her talk about this, but not probably today. Singapore is one where Hanteng Chua, our economist, is saying that the 2025 amazing performance, the 4% growth, is probably unsustainable. Probably goes back to the trend to 2.25% in 26 and 27. And for North Asia, you will hear a little bit about Taiwan from Ma Tiying, but also for Korea and Japan, we're talking about some degree of slowdown after the breakneck sort of numbers we saw in 2025. And then when we talk about beyond growth, the inflation issue, something that we used to worry a lot about in the past, today it's only with respect to the US, which is why instead of showing you a chart of inflation around the world. I'm just showing you the Michigan Expectation Survey for inflation coupled with consumer sentiment. So it's interesting that while I touched upon earlier that American consumers' appetite remains voracious and imports are substantial, their sentiment is not good at all. And you can understand why when you open a newspaper in the US or watch a US news website, it's nonstop action. Most of it is negative, and that certainly weighs in on people's expectation. But people's pocketbook, despite all this talk about white-collar jobs disappearing or labor data beginning to weaken, it seems like people still seem to have made a lot of money in the stock market, or if they own homes, they've made a lot of money in their home capital gains, or they got a lot of support under the previous stimulus measures during Biden in 2022, 23, and 24. And hence, consumption remains unimpeded, although consumption sentiment is poor. Inflation expectations rocketed in the aftermath of the reciprocal tariff announcement, have softened a bit since then, but it's still fairly elevated. But again, this is really a US-related question. When you look at country-by-country inflation forecasts, we're not worried about inflation anywhere in the region. Food inflation is not a big worry. It was a worry 3 years ago. We have managed to really balance the global supply and demand dynamic as far as food inflation is concerned. Energy, we have been consistent with this issue repeatedly, and you can read in the Outlook, Subra Sarkar's presentation on oil outlook, ample supply around the world, despite all these geopolitical hotspots in Venezuela regarding Russia, Middle East, elsewhere. Global demand is fairly weak, led by China's green transition, but also in general. Energy intensity is not what it used to be with respect to the demand for fossil fuels because the world is deepening its stack of renewable energy infrastructure. Hence, we're not particularly worried about energy inflation either. And once you take food and fuel away, as far as Asia, North Asia, Southeast Asia is concerned, there isn't much left in inflation dynamic to speak of. India, this year, exceptionally low inflation. Next year will pick up a bit. But as far as RBI's inflation target is concerned, 26, 27 look pretty good. Room for very constructive play on monetary policy there. Okay, my final slide before I go to Mo, who will then cover China, is the things to watch for 2026. First and foremost, U.S. financial markets. I think we all know that the market valuations in the U.S. are at nosebleed level. Credit spreads have never been this narrow. P of S&P 500 is basically back to the pre-GFC days. That's high. You have famous short seller Mike Burry, again, talking about his short on AI-related stocks. So that could be the source of, major wealth destruction in 2026, 2027, if indeed we see a big sell-off. So that remains at the top of the thing. Trade deal volatility, I guess it's given. No trade agreement with Mr. Trump is sacrosanct. It can change tomorrow on a dime, and hence that volatility remains in place, including very soon what the Supreme Court says with respect to Trump's use of emergency measures to impose tariff. But I'm sure he will find many other creative ways to squeeze the tariff button repeatedly in 2026. U.S. monetary policy credibility, we can spend a whole webinar on this. We worry a lot about it. There will be podcasts on this later this year. What happens with Fed leadership? What happens with Fed's playbook? Lots of questions, and that is definitely something to watch. And if the Fed does keep cutting, even as inflation remains high, curves could steepen. Eugenia will talk about this risk. Could we then see the Fed start doing what the Japanese did or the Europeans have done, yield control, curve control, and so on? The U.S. financial markets risk that I mentioned at the beginning, what are the triggers of that other than, say, an earnings surprise? It could be what happened with the DeepSeek situation. That could we see a major invention or introduction of a new product from China that again tells that some of the model pursued by the Silicon Valley world in terms of investing in data centers and ever-increasing cycle of model training is the right one or not. So hence that DeepSeek moment is also another risk. FDI surge to ASEAN, to me, that is a good thing to watch out for. We see the world, maybe not the Americans, but from Europe to North Asia to East Asia to India, everybody is looking at ASEAN's criticality in the global supply chain, and that investment dynamic remains unchanged. And then finally, very quickly, ASEAN-India proximity. Maybe I'll ask Radhika to talk about this later. There isn't much time left for me. I will now pass the baton to Mo. Mo, talk about China.
Thank you, Tama. So for us, we think, for China in the past 5 years and also in the next 5-10 years, it's going under a great transformation from the old economy to the new economy. The old economy, in terms of investment, is mainly led by property. but for the next 5-10 years, it's major led by high-end manufacturing investments. So we keep like consumption and exports as status quo. But here, in terms of the investment itself, so why China has been so robust, especially in high-end manufacturing? If you look at the right-hand side chart, that's one of the favorite charts from Taiwan. So we see from 2023 to 2027, US has been critical, technology holds over 60, but now China holds over 54. So I want to explain why is that? Why China has been so leading in all those critical technologies? I think there are three fundamental supporting forces. Number one is about energy production and storage. Over the past 40 years, China has been leading in this, especially currently for the energy storage, such as CATL, in terms of the batteries, they're much, much powerful. This actually gives a fundamental support for the technology innovation. Secondly, we think for this tech leading, China also has this talent dividend, not only from scientists, but also engineers. So if we look at DeepSeek, we know for DeepSeek, all those engineers were trained domestically. Over the past 4 decades, China has accumulated this huge amount of engineers, scientists for this round of this technology innovation. And number three, we think most importantly, is about manufacturing upgrading. So China, over the 40 years, manufacturing upgrading has made all this tech innovation possible. So this is why we think, in terms of the energy dividend, in terms of talent dividend, and also the manufacturing dividend, that makes China's tech has been leading. Then, in terms of China's manufacturing, now is accounting for over 38% of its fixed asset investment. So this, as economists, the first time on the right-hand side chart, we have been seeing fixed asset investment in total has been going in negative territory. It has been mainly supported by manufacturing FAI in China. So this is why in 2026, we are thinking China's GDP growth will be around 4.5%, but it was mainly driven by manufacturing. So tomorrow, DBS is also holding a very important conference in Beijing, talking about new productive forces in China. Such as we look at an example, China's 20% of exports is on semiconductor. And in terms of manufacturing value growth, globally with China has been much higher than the global growth. The industrial production year-over-year for industrial robots has been much higher. If you see, that's over 20%. So this is the most of China exports, but because of manufacturing, China has a whole supply chain, it's a complete supply chain that supports all this is developing as fast as possible. On top of what have been talking, the supporting points for 2026 and also the year going ahead, especially 2026 marks the start of the 15th five-year plan. But China still has the coexisting of the old economy, especially the property sector. So the property sector still remains as the weakest link. We see year to date, China's primary market sales in the 300 cities continue to down around 8.9%. And if we see the residential inventory in terms of turnover in 80 cities by months, on a 12 months average, is still at around 27 months. So this means the property market slowdown will continue. According to our own research, we expect China's property market will only bottom, stabilizing in the mid of 2027. Beyond we see the property sector, we also see for China's consumption, the aggregate demand in China is still weak. If you look at China's retail sales, overall it's around 4% growth, but where it has been growing good is about all those sports, recreation, experience related. But if you see the household deposits, the percentage of GDP that has been dropping. So they are really deposit as much as possible. So, but in terms of employee expectation different index that's made by PBOC, that has been dropping severely. So the household disposable income has been one of the key constraints for the household to spend. This is something for us to worry. China is also ongoing another supply side reform. So to deal with this overcapacity and this anti-evolution. So as the auto sector, as an example, we know EV cars, China has been selling not only domestically but also overseas. But now you see from this left-hand side chart, in terms of the fixed investments in the auto sector, that's growing at 17.5%. That's much higher in the industrial production at 13.4%. You invest more than you produce. Then in terms of retail sales, that only grow at around 11.8%, meaning you invest more, you produce less, then you sell less. So that means there's a big pressure on your prices. But given this overcapacity, anti-evolution, now we see China's PPI has been kind of stabilizing and is also coming up a little bit. But this supply side reform will continue. That will give pressure to the overall economic recovery. Also, one of the headwinds for China is about these trade tensions with the United States. We know in the past, ever since April, there are several of the triggers for each of the trade talks between U.S. and China. It has been around the supply of the U.S. inventory, about the rare earths, about agricultural products, etc., etc. But in our thinking, we thought into 2026, that will be very similar to 2025. China holds much more cars than the United States. If we list 5 major cars China holds, number 1, certainly, that is rare earths. Given to our own study, we think in the next 3 years, when Trump is in office, it's hard for Trump to build a whole supply chain of these rare earths with the talents, the equipments, the refining techniques, and etc. Secondly, we think in terms of agricultural products such as soybean, etc. This is also a card China is holding. Number 3, we think what China holds, in terms of the kind of fight with the states, is about, in terms of China has the U.S. Treasury bills. So this is still around 731 billion. So whenever China sells, that will give a pressure to the U.S. But also China holds a card in terms of making they never give in, meaning there will be uncertainty for the U.S. markets. So all of these cards holding in China, meaning China will not give in. China still aiming to have achieved around 10% of the tariff. So China is very tough on this stance. But for the U.S., they may have control in terms of the key technology, export to China, but also they may execute around financial sanction. This is something from China side, they also will try to make sure it will not really impact China's domestic big circulation economy. So this is something we see in the next year before the U.S. midterm election. The trade deal, will be relatively on a base because China will not really give in. So in terms of we also see one of the very positive signs, for China and Hong Kong market in 2025, and we think that we can continue into 2026 and even beyond, is the return of the foreign investors. Especially for China here, we see the recovery in terms of the M1 and M2 growth. Then most of the money actually has been going into the active markets. So the net capital inflow by non-residents in both equity and debt has been going back. If we really go into see the specific sectors, now we see for both the China markets and also the Hong Kong markets, mostly they are going to the tech sectors. This is at the beginning, as we said, China's tech now is really growing very fast. That attracts a lot of the foreign investors. If I touch down on Hong Kong markets a little bit, now we are seeing Hong Kong's economy in 2026 will grow around 3%. This is mainly supported not only by the capital market booming, but also we see the property market in the second half is going to stabilizing. So the inventory level will peaking around the mid-year. So this also gives a very important stabilizing factor for the Hong Kong market. Besides this, we also see Hong Kong's retail sales is stabilizing as well. So visitor tourists are coming back to Hong Kong. Big events are being held in Hong Kong. So this is along all these factors, Hong Kong economy is very much supported in 2026. So this is why we're seeing around 3% growth in Hong Kong. So I will pass along to
Thank you, Mo. That was the China Hong Kong part. Eugene, some rate stuff for us.
All right. Thank you very much, Mo. Hi, Mo. So on to my section on rates, right? But before we get there, if there are any questions, the QR code is over there, so we'll be happy to address them towards the end of the presentation. And now on to the main topic of rates, right? So the way to think about rates is that there's a fair amount of noise over this year. And filtering out the noise is not easy, right? And I think in the end, when we look through the different teams that are running, it is easiest to pave it as the central banks are getting towards neutral. And that applies for the G3. For the Fed, they've started cutting rates again, so 50 basis points this round after an extended pause. We think that there will be another 50 basis points to go, notwithstanding some of the pushback that comes from Powell and some of the Fed officials' comments over the past week or so. Now, neutral is an elusive concept, but we won't really know in real time what neutral should be. So for the policymakers, for the markets, for us, it is a best estimate. Right? So, and this estimate is based on certain baselines, certain shocks, certain assumptions. Right? And this can shift over time. But we think that at 4%, the Fed probably still needs to cut a little bit more. Right? For the ECB, they are probably already at neutral. They have cut a lot more aggressively this year compared to the Fed. And with policy rates at 2%, inflation 2%, and the growth outlook for next year that would be better than this year amidst fiscal loosening in Germany, there might not be much for the ECB to do. In fact, the hurdle to move either way should be set quite high, right? And I think this is communicated over the last few ECB meetings where they have held steady. So the BOJ is another matter altogether. So they have different considerations, right? So if you look purely from the economics lens, if inflation is really sticky above 2%, then central banks should be hiking rates aggressively. However, if the policymakers are more worried about sustaining economic growth, making sure that the financial system is stable, then there's a need to take a much more measured approach. Regardless, we think that there will be at least 50 basis points more of hikes upcoming. It will be delivered at a slow pace, but the direction of travel is clear it is higher. Now, neutral for policy rates is one thing, but neutral for balance sheet is another thing that we have to consider. So the Fed has announced that they will end QT in December. Right? So there are signs of strains that the financial system is getting tight. If you look at some of the short-term interest rates, there are spikes, and these are not just concentrated within the month ends for them. So it is timely. This has been heavily discussed. In fact, we think that the financial system is probably a little bit too tight. And given the size of the economy, the size of deposits, the size of the financial system, there probably is a need to inject a little bit more liquidity over time. So we shouldn't be thinking about that as QE is more of a liquidity injection so that the financial system can function. Now, the ECB will likely follow suit sometime in next year. So QT will probably stop. Now, for the BOJ, it is running QE, but at a slower pace. Right, so I think we need to consider the amount of net liquidity injection for G3, and it is coming to balance. Right, for the most part of the past 2 years or so, it has been negative, and we are coming to the point where we are balanced. Now, what about teams? Right, teams are important when we consider not just the short term, but also the long term rates as well as curve shapes. And so if you want to look at the immediate term, there are 4 things that we should be watching out for. So the first would be the firing of Lisa Cook from the Fed. We'll be watching for the oral arguments in January. So that I will classify as high impact. If she really loses her job, then the risk of loss of Fed independence is high, and that could result in overly low short-term interest rates compared to what economic conditions warrant, and that could lead to very, very steep curves, perhaps a surge in sentiment, but there will be a swift follow-up in the overhang. Right? The US government shutdown, yes, it has ended. It was the longest on record, but the can has only been kicked down the road another 2.5 months or so. So if this is going to be a recurring theme, then I think the economic disruptions are going to be more frequent, and that can't be a good thing in terms of economic activity or maybe a dampener. right? The legality of Trump's tariffs, another thing that we should be watching for December, January. The immediate reaction, if the tariffs are found to be legal, could be a pop in yields, right? Because maybe the Fed doesn't have, or maybe the government doesn't have enough revenue for a while. But this should be temporary because Trump has other ways to get tariff revenue. So I think it is a short-term kind of negative impact, but it should be smoothed out over time. The last one would be Fed chair replacement. So 5 candidates would likely to be announced in December. So I think this is a known unknown. Regardless of who gets chosen, the Fed chair would have a dovish tilt, right? So I think on balance, if it is someone that is already within the Fed, it probably will be viewed more as continuity. So even though Bowman and Waller are considered to be doves in the Fed, but at least if you look through the credentials and what they've been talking about, there is still a sense of credibility in terms of policy making. Right? So what I've talked about are the shorter term, immediate term events. But when we think further out, like the entire of 2026, there will be some recurrent things that could pop up, right? So resurgence of inflation risk could come back. I think there's a little bit of complacency kicking in, because if you look at the headline CPI numbers, it doesn't look like the US is getting much inflation, even as the tariffs have come into play. You're seeing some of the pass-through in goods, but if you look at the other segments such as shelter, energy, if those are muted or coming off, then from an overall basket perspective, it doesn't seem too problematic, right? But if we have a surge in AI-related investments, and it's a rebound in terms of hiring at some point next year, then there could be a rewriting of where rates are, and therefore repricing across all the asset classes. And bond vigilantes linked to inflation, but also linked to the fiscal issues. Right, fiscal issues have gone to the back burner, as we have noted over the past few months, because there are some revenues that are kicking in, and the deficit is not really deteriorating. But if you want to think about it structurally, there's no real attempt to try and curtail the overall structural deficit of about 5+%, even as the US is doing relatively well. So this is a theme that comes every once in a while, right? When the G10 is not the US, it can be Japan, UK, even Germany, right? So these kind of things are recurrent, and it is likely that at some point in 2026, this theme will be revisited. Now, the immediate issue then is really on the K-shaped economy. So that deserves a little bit more attention, because I think this theme has been playing out for some time, and the issue is whether the K will snap back. Right? There are a few charts that can illustrate the point, right? So the divergence between stocks rising and yields going down, right? Does it really make sense, right? So if things are doing that well, then one of them is probably wrong, right? The economy is doing that well, then the stocks are correct and the yields are too low. Conversely, if the economy is not doing that well and 10-year yields are capturing this more appropriately, then stocks should be lower, right? It could be any combination of those two, but it is unlikely that this trend will be sustained for certain periods. Now, the second thing is that I think most people at the beginning of Trump's second term would think that Trump is positive for stocks, and then that is probably how he manages his popularity. But if you look at his approval ratings, it has been dropping significantly, diverging from the rise in stocks, right? So that's something to consider, right? So as we approach the midterms in a year from now, Trump might have to do something to try and arrest this kind of statistics, right? So is there a need to perhaps give more cash handouts, right? Would there be an impact on rates, right? As the US economy unbalanced, right? So these are the things that, from a rates perspective, is incredibly important to monitor. Right, so here I will just shift gears. I'll be talking more about Asia, then how the interaction between FX and rates have played out. Right, so just compare it over the past 11 months or so since the end of 2024. Right, so if we look at the performance, the US dollar has been very, very weak, and that's on the top left quadrant, right? Weak plus yields are lower, right? Which makes sense, right? So the bulk of the weakness is actually taking place in the first half of the year. And then we have the Fed cuts and slowdown worries that's keeping yields low. And the other end of the spectrum, we have German yields, right? So we have the switch, right? Loss of confidence in the US, switching to Euro being strong, plus we have a lot of additional fiscal stimulus coming in. So yeah, that helps. So for this kind of environment, generally, Asia is doing okay. So if you look at Asia, barring a couple of exceptions, we have yields generally much lower for the year, right? A weak dollar helps, lower dollar US yields help. Now Korea is an exception because of one volatility, fiscal stimulus. China, because a lot of pessimism were baked in, and therefore yields actually rose modestly for the year. Now, if we look into next year, I think we are broadly constructive, but that is really a medium-term view. Because if you look at it in the short term, there are some areas of concern. So if you look at the average of 10-year yields, Asia, red line, and then gray lines for the G10, we have converged, right? And then the premium is on the right side hand side chart. Premium has dropped close to zero. So there are good reasons why Asia govies have outperformed so much this year. The argument is not so much on whether the conditions over the next 1 year will be benign or not. It's more of a risk reward, and that there is a key risk that if there's a rebound in the US dollar or a rise in the US rate, that would erode the attractiveness of Asia assets, right? So this is a matter of valuations. So investors probably will have to be more picky at this stage of the cycle. So these are the takeaways. We are going towards neutral as far as the G3 central banks are concerned. This applies for both policy rates as well as balance sheets. In the immediate term, from an economic perspective, I think the K-shaped economy is a challenge. But for Asia, I think conditions are generally supportive if you want to look over the medium term. But in the near term, the compressed yield premium presents a valuation challenge. And the biggest risk is for us is the US dollar becoming strong against the odds. Right? That would be a big headwind for Asia.
Excellent. Eugene, thank you very much. Although this is a 2026 outlook, there is a 2025 question. So let's put that on the screen for a second. With US debt at record highs and the AI rally showing signs of cooling, how likely is a Fed rate cut by December 2025, even if inflation stays sticky?
Yeah, I think the issue here is it is not really a balanced mandate at all times, right? So at certain times, it is more important to weight labor. Sometimes it's more important to weight inflation. And I think people are okay with 3% inflation. So are policymakers, right? So 3% inflation, and then it is not too much of a hurdle to cut rates once more in December. That's still our base case, just to safeguard against some risk that the labor market might be stalling, right? So a hawkish cut into a slower pace, if needed next year, seems to make the most sense.
Absolutely. Excellent. All right, Philip, time for some currency.
Okay. Thanks, Timer. Thanks, Mo. Thanks, Eugene. I have very few slides, because most of them have covered most of the issues that we're all thinking about. So I thought I'll just give you the bottom line for FX. But before I do that, please ask. The questions are trickling in, so we do like them longer. Yes. Oops. Okay. Oh, sorry. Okay, this is the So this is the Pigeonhole QR code. Code is DBS GR 2026. Okay, so send your questions in. We love answering questions. Okay, so before I think we need to look back at 2025. Look at how the big dollars pan out. Most of us, are still very negative on the dollar. You can see it in the forecast, just not just from us, but across consensus. Some of the houses have actually raised, their euro forecast also closer to 125. So euro being the anti-dollar. But I think what I want to do now is to review, because there are certain questions that have popped up for me. Okay, but overall, I think as far as the Trump-driven dollar weakness is concerned, it's still showing up mostly in the euro, which is the anti-dollar, and Swiss franc still playing very much the role of a safe haven. And interestingly, for the second half of the year, most currencies actually have struggled, to extend the gains against the dollar. In fact, most of them have given back. So the ones that have been quite resilient has been the ringgit and dollar China. So ringgit is really a latecomer, very much on the back of the very successful ASEAN summit that Prime Minister Anwar Ibrahim carried out in October. And and the renminbi, to be honest, has been in the range since they had a new PBOC governor since July 2023. So we're simply moving towards the stronger side of the range. Okay, the resilient currencies, of course, need no introduction. Sing dollar is, Sing dollar is probably one of the most popular ones. One of the few remaining AAA currencies. Thai baht, like Taiwan dollar, has been intervening to stop the currency from appreciating. Australian dollar remains a proxy of relative monetary policy, and recently the resilience has been attributed more to the RBA cooling off rate cut expectations. The most disappointing has been the yen and the Korean won. But interestingly, the stock markets are doing very well because their currencies are not. So these countries like very competitive currencies. And of course, the weakest have been mostly the BRICS related, except for the Philippine peso. Indonesia on fiscal worries after the violence that we've seen, and in the Indian rupee, because of the bad I think trade talks that they had with the US, so but right now they're also in the process of maybe getting back the tariffs down, just like the Swiss and the Vietnamese dong, persistently staying weak, but not that weak, but generally has a competitiveness bias. Okay, moving on. So what do we see for 2026? I think when we look at all the factors that is coming in, and also in light of the latest state elections in Virginia, New York and New Jersey, so leaning very much towards the Democrats. So you do see that the dollar is entering 2026 politically wounded and cyclically tired. Cyclically tired, as in now we have worries about job insecurity accompanying the Fed's continued vigilance against tariff-led inflation. So Thursday we're going to get the US, I think, non-farm payrolls. So just before we started, I was just telling Eugene, wow, are we going to get a shock if suddenly, because we had weak numbers in the previous months. So what happened if suddenly the numbers are in as weak as what the headlines are saying, and it comes out maybe more than 100K or maybe 200. Okay, so let's just keep our fingers crossed. Okay, so we'll probably have another call for that. Okay, in any case, there's been a lot of talk about the Mar-a-Lago, which is a Plaza Accord style of dollar decline. Okay, but the problem with this call is that it needs, the Fed cuts to come in, because US rates, like it not, are still the highest among the major currencies, and there's been a major drag, so which is why currencies are still very sensitive to what Powell says. Like what we saw in the last FOMC meeting, when he, when he surprised everyone by saying that, a rate cut in December is not a done deal. So, but nonetheless, I think because of the shutdown, job insecurity worries are coming in. So, I think it's a 50-50 call, but of course, I would lean my 1%, to to my colleagues here who's still calling for a rate cut in December. Pretty much the same, with the call for BOJ hike also in December. Okay, so but next year, I think one of the things that I can't shake off is the Fed's independent risk, because like it or not, Powell's term ends in May, and most likely, the thinking is that Trump has appointed Powell, and he has regretted that decision. So so he's trying to make sure that he doesn't make the same mistake again, and that we'll probably have more dovish Fed governor, assuming that inflation remains controlled. So far, inflation, I think if you look at most of the inflation expectations, problem is that the level is still high, but it is not going up. So that's the good news. And and I think the door is open for them, to the temptation, to ease will be there given the stakes at the midterm elections. So I think we're exactly about a year from the midterms, and Trump, I don't think would like to repeat the mistake of his role model, President McKinley, who is the original tariff man. So he was the one who hit very hard on the tariffs, but he lost the midterms on inflation. So
What happened at the end to him, Philip?
he was assassinated.
Yes.
Yeah. Yeah. So, but with Trump, it seems to be the other way. Like he survived. So, okay. So, and of course, the Supreme Court's decision on the IEEPA tariffs is still hanging. Though recent news seems to be indicating that they may rule against it, but then the problem is when, and with the elections coming, and then you have a lot of trade deals. I mean, this has a lot of implications, not just in terms of the trade deals, but also in terms of its role as a fiscal stopgap. So I think this is where the bond market has also shown, I think, nervousness that if they rule against it, then the fiscal deficit risk may return, and we get sort of like second quarter, what we saw this second quarter, the dollar credibility risk if AI takes stocks down, and if fiscal worries come in, and the dollar again loses its credibility with markets. So far, dollar has been quite resilient. One reason is that the stock market has come back quite nice and strongly. But overall, we are still profiling for a weaker dollar. But I pulled back my bottom for the dollar at a higher level, now closer to the 95, and also around the third quarter, in between end of Powell's term and the midterm elections. So let's see how things play out. Okay, and along the year, we have a lot of thoughts about does Trump really want the dollar weaker? Well, I do think he wants the dollar weaker. I think it's part of the MAGA agenda, and I do believe that they see addressing imbalances, will require lower rates and a weaker dollar. Okay, so they have already more or less, I think, done their bit on the tariffs and trade deals, as well as the one big beautiful bill. So, but what they have come up with is also, which what some people see as inconsistencies, that they don't want the dollar to lose its dominance or its hegemony. So they have surfaced when euro was when everyone's talking about euro threatening to rise above the 120 level, and Europeans themselves also do not like, the euro to be too high, too fast as well. Okay, so then on the trading partner side, so the de-dollarization story has really been around for quite a long time. It's pretty much a response, to U.S. Dollar weaponization. Okay, so just to cut a long story short, generally, I think trading partners being faced with, a very uncompetitive or unfair, terms, do not really want their currencies to weaken too much. And of course, the big surprise is the big surprise has been the emergence, of China and Brussels, both talking about taking a bigger global role for their currencies. Okay, but at the end of the day, so when you want to move away from the dollar, you need alternative. But then when you ask around, most people are still, not convinced about China and also about Euro anytime soon, and especially for China, where it's still closed on the capital account. Okay, I need to rush. Okay, so this is our forecast. I've already mentioned that dollar bottoms, we expect dollar bottom in third quarter. So this is the returns in terms of interest, split it up in terms of interest rate and the spot. So generally, I think the profile is that the yen to us is undervalued, but it has a negative carry. Okay, so we'll probably take a look at this chart, and maybe we'll answer more questions during the Q&A.
We have a question for you already,
Okay.
actually. So let's put that on the screen. So Philip, last month, you and I and Chua Hanteng collaborated on a box in the Singapore 2040 report, in which we talked about the possibility of Singapore dollar going to parity against the US dollar in the next 15 years. The question is, as you can see, if DBS expects USD HGD parity by 2040, how should investors position their portfolios between USD and HGD based from now till 2040?
Okay, this projection actually requires very much the big dollar story that we've been talking about, sort of Mar-a-Lago. So I've sort of calculated in past cycle, the Plaza, then the GFC, and generally we need the dollar to drop about another 20-30%. But then we're talking about quite a long-term time frame. So I would say that the Sing dollar has proven time and again, unless we have another Asian crisis, unless the US really surprise, unless we have some kind of geopolitical risk in the region, so primarily I think if SCOTUS rule against, I think the whole world, including the US importers, will be looking to water down the trade deal. So and I think the de-dollarization move will come in. So these are the things that I am watching in terms of repositioning. But of course, and Sing dollar being the Sing dollar, we have always been foreigners, institutions, they've always like our strong Sing policy, which embodies the way we manage our economy.
Right. Thank you, Philip. My personal view would be that if we're talking about balance sheet management, holding on to a AAA asset like Sing dollar and Singapore bonds and Singapore stocks make all the sense in the world for the medium term. So I would recommend it without any hesitation. Mo, one question on China. After that, we'll move to India and bring Radhika on board. Do we expect any stimulus in China? If yes, in what form and when?
We do not expect big stimulus from China, given the property market is relatively stabilizing but not collapsing, given the US-China trade truce, given the rise in the stock market. But we also expect some kind of stimulus in 2026 because that's the start of the 15th five-year plan. Usually, China will spend big on infrastructure investments. China will continue on its manufacturing investments. For the fiscal side, this is what China is going to focus on. But from the monetary side, even though PBOC has been stressing they will do more in terms of price easing, but not the quantitative easing, but we think the room for them to do the price easing is very limited, given the rates are already very low. rather do more open market operations to inject liquidity into the system. But as a whole, we do not expect big stimulus coming from China, given all those stabilizing factors in 2026.
So since I went with Eugene on a 2025 question, let me also ask you about 2025 question. Very recent data out of China seem rather weak. Does that make you rethink the 26 outlook, or you think it's not that shocking?
China's economy has been weakening, especially from the old economy. Then, as the beginning I'm saying, there's a coexisting of the old economy and the new economy. So never people say China's economy is good or bad. Old economy is bad, but the new economy is good. They are coexisting, and as you said, there's a separate paths. They are really evolving into the separate paths. So this is why we have to be focusing on, especially on the new economy, the high-end manufacturing, the technology innovation, all those for the future.
Fantastic, Mo. Let's just keep this QR code on the screen so that everybody can scan and ask questions if they choose to. Radhika, are you there?
Yeah, hi.
Few words on India, a preview of your India outlook coming out next week.
Thank you so much. Certainly, I think today's annual outlook will provide a good overview, and then we'll have some individual reports as well. Delving into India, certainly, I think the theme for much of 2025, and I think that's going to continue into 26, it's going to be about the shift in strategy to strengthen more the domestic story, because external environment is certainly not friendly. India-US trade deal seems to be imminent. A lot of commentary coming out of Washington and Delhi. But let's see, when that unfolds. Until then, India has already announced some trade support measures. But coming back to the outlook, we do think that, there's going to be more and more levers being used, especially by way of indirect tax relief that has already been done. Rates have been cut. Liquidity will be maintained in surplus. Regulatory measures, more government capex spending. And inflation is low. I mean, when was the last time we heard about India's inflation being sub 2% at an annual level? So all of these things we think will benefit the growth story. Insofar as the numbers are concerned, we have a 7.2% growth forecast for the fiscal year that we are in, going into about 6.5% for the next year. So quite strong as compared to, good parts of the region. We had published Asia 2040, so that also gives us a bit of a medium-term view on where we see the economy going. And just taking most point on new economy and old economy, in India's case as well, data centers, semiconductors, electronics are becoming a bigger share in terms of the industries that are doing well, attracting a lot more investments. And lastly, taking a leaf from what you had mentioned about the India-ASEAN corridor as well, certainly I think this entire story of diversifying your trading partners, investment partners continues to be a theme for India. In fact, ASEAN already have a functioning FTA, so their trade has been growing under that umbrella. Singapore plays a very important part. In fact, we have a DBS India Day later this week, where we're going to be showcasing more of the capabilities as well. And I think under the new economy, I want to just leave a last example. EV player from Vietnam, VinFast, is opening a manufacturing facility in India and also domestically supplying, and has in fact done better than Tesla in terms of the monthly sales. BFSI, data centers, real estate, infrastructure are some of the sectors that ASEAN players have found of interest. I think I'll stop here and pass it on to Hunting.
Just one second, Radhika, just to one concluding thought on India. You mentioned VinFast and its traction that it's having in India. Of course, as you know, my favorite EV story is MG. We see that as a joint venture between a Chinese corporate and an Indian corporate and a full tech transfer, 50-50 joint venture. I think that that's a very good blueprint for ASEAN countries and for South Asian countries to trade with China, but with stronger terms, as opposed to succumbing to the fear that Chinese manufacturing will just take over the country and Chinese technology will just overwhelm them. Thank you very much, Radhika. Hunting, although I wanted to come to you and ask you about Singapore, which you will, just be ready that after you're done with Singapore, I have some Malaysia-related questions for you. So go ahead.
Yeah, certainly we'll keep very much closely to the ASEAN narrative as well. But just bringing back to the global economy, I think Singapore is really quite plugged into the global economy. one of the highest exposed to trade. I think 2025 has been quite resilient for Singapore in terms of its trade numbers as well as for the Southeast Asia region. But for 2026, I think we'll see some normalization as the lag impact of tariffs start to feed through for the Singapore economy. So in terms of growth, we're expecting around 1.8% in growth terms. And I think we shouldn't see this as a negative outcome, as this is actually quite close to potential growth for Singapore by and large. While the trade-related sectors would see some headwinds, I think there are some areas of resilience, and I think that's why I titled the column the page that we have in our outlook as measured resilience. And we see some resilience in the modern services sector, which is quite an important part of Singapore's diversified services economy. So financial services would continue to be supported by, say, the low interest rate environment, even though the global environment is uncertain. Secondly, I think in terms of AI digitalization, I think there's a strong push in Singapore, as heard during the National Day rally this year, to push SMEs as well as big companies towards a greater usage and adoption of AI, which will be quite crucial to Singapore's growth over the coming decades, as productivity would help to support the economy amidst aging. As well as I think we talked about the theme of attracting FDI, and I think Singapore continues to stand out very strongly as a trusted and reliable business hub, and that will provide support to the professional services sector. And very lastly, I think just across our office, we are seeing the expansion of the Marina Bay Sands Tower 4, and that will provide a source of support for the local construction sector, which is in a boom, and also other major multi-year transport infrastructure investments like Changi Terminal 5, port expansion, the continued demand for housing. That would be a source of support. Inflation-wise, I think Singapore has seen inflation come down to a quite low rate in 2025. I think one key thing that Singapore is still quite committed to is climate change, and some of the administrative price changes, for example, in carbon taxes or introducing new sustainable fuel levies, might put some upward pressure on inflation. But by and large, I think if you look at external price pressures in terms of oil prices, they're still quite contained. So what does this mean for cyclical policy? I think me and Philip has discussed quite a bit as we are thinking about this annual outlook. So MAS, we think, will keep the powder dry in 2026, as I think in this uncertain environment, it still keep its modest appreciation for the Sing dollar, as they have done some easing measures in 2025 in the first half to counter some of these downside trade risks. So in that sense, MAS would still take a wait and see approach, and and this would be consistent with its expectations of a narrower output gap and slightly higher inflation. I think lastly, the government is having a economic resilience review and will try to sustain its competitiveness. And I think that also is our thinking behind how over the longer term Singapore can still remain quite relevant and try to power to a $1 trillion economy by 2040 with all these forward-looking plans.
Thanks, Han-Cheng. Questions are really piling up, but while I ask you something on Singapore, can you turn your volume up a bit, because you were coming across a rather muted? Okay. So on Singapore, the question is trade-related matters. Pharma sector and semiconductor, a lot of concerns this year. Would it be safe to say that Singapore has more or less managed and bought quite a bit of time in both sectors?
So I think two issues here. Pharmaceutical tariffs would be quite a huge hit to Singapore given its reliance. But I think based on what is being announced currently, while it's targeted at branded pharma, high value pharma, there's certain exemptions. And with respect to that, I think the global pharmaceutical companies have committed to investing in the US, and that would provide a source of cushion and limit the downside impact for pharmaceuticals. In terms of semiconductor tariffs, I think the risk is still there, given that Singapore is still quite plugged in to the global electronic supply chain. But I think an offsetting factor is that there's still this AI boom that is continuing, and unless there's a deep correction on the AI front that dents the investment intentions there, then I think risk would be significantly on the downside. So by and large, I think we still expect some support for the electronics cycle, although it's quite mature at this juncture for Singapore.
Right. I think that's a critical one. It actually partially answers another question that we have gotten recently. By the way, we have a lot of questions. The question was, what is the single driver of our risk for the US financial markets in 2026? It is definitely the AI story, but it is not just about the US stock market getting derated by 10, 20% or more because of AI sell-off. The fact that it can then have a ripple impact in the supply chain of Asia, because Asia is also very long the entire ecosystem around AI infrastructure and electronics. So I'm glad you brought that up. So as you can see on the screen, Hanteng, let's go over this very quickly because we have the QR code for the publication and people know that, yes, we are standing by our 2026 forecast of Malaysia of growth about 4% in 26 and 4.2 in 27. And yes, 25 basis point cut. And then the ringgit of a marginal appreciation of the ringgit. Anything else you want to add other than the fact that we already have all those forecasts in our publication?
I guess the key thing here about the Malaysia dynamics is that there's a sense of cautious optimism. I think domestically, the economy is doing well in terms of private consumption, upward investment cycle in terms of FDI going to Johor, Singapore, SEZ. That's all positive things. But I think on the downside, we still have to be cautious about the external outlook and semiconductor tariffs that would place a big hit on Malaysia if they were imposed. Although we have to really see how the conditions might play out. We know that Malaysia is in talks with the US on potentially zero chips tariffs, but that's probably quite a far-fetched. But any tariff negotiations that below that of any sky-high rates that's threatened now should be taken as a relief.
Right. There's an additional question about the potential impact of the Supreme Court decision. I think that's a global matter, not just Malaysia specific. By and large, I think the US president has many other ways of imposing tariff, not just with emergency measures. It will create complication, but I think that would be a broader global issue, not necessarily with respect to implication for the Malaysia-US trade deal. Hanteng, thank you very much. Stand by. There might be more, but let me just go to Tieng, who has been patiently waiting for us. Tieng, a few words on Taiwan. And after you're done on Taiwan, touch on that issue that Hanteng and I just discussed, that could a correction in the AI complex also put pressure on exporters like Taiwan in 2026?
Sure. I think I will answer these questions together because Taiwan focus, in fact, is very much about AI. This year, Taiwan has very strong economic performance. GDP growth will be more than 7%. That will be a very big surprise to many people, despite the Trump tariffs. Despite the volatility of the Taiwan dollar, in fact, Taiwan still maintained very strong GDP growth, about 7% this year. And it's very much due to AI-related demand. For 2026, we expect growth to slow down compared to this year. We are looking for 4.8% growth in 2026. So this will be lower compared to 7% this year. But if compared to Taiwan's long-term growth average, which is 3%, 4.8% will remain relatively strong. So global wise, if we look at the AI cycle, one indicator we look at is the capital spending by major global cloud services providers, CSPs, including 5 from the US and 3 from China. Their total capital spending this year will increase 60% year on year. And for 2026, the capital spending plan is 600 billion in total. That is about 40% increase compared to this year. So growth rate is peaking and is slowing, but it will remain strong. And another indicator we look at is the US fixed investment into ICT sector, including both hardware and software. So this indicator, the growth rate currently is around 15% year on year. It's double-digit growth. The growth rate is already similar to 1990s. So we can say that there are some sense of overheating. However, if we look at the duration of this double-digit growth rate, currently the duration is around 2 to 3 years. In 1990s, the duration was 5 to 6 years, from 1995 all the way to 2000. So we can also argue that although there are some sense of overheating, the magnitude of overheating probably is not yet as severe as in 1990s. On Taiwan side, we also have some important data to track. As we know that Taiwan is a major supplier of advanced logic chips in the global market. It's also the major supplier of AI servers in the US market and also in the global market. So if we look at Taiwan side indicators, the semiconductor export orders, ICT exports, and also the inventory to shipment ratio, what we can see is that Taiwan's tech cycle remains expansionary. The growth rate might be peaking, but the cycle so far remains expansionary. So based on all the indicators we track currently, we think this cycle will remain expansionary into first half of 2026. The growth rate is peaking and probably will slow down, but the cycle will remain expansionary at least into first half of 2026.
Absolutely fascinating. Ting, I can't wait for your Taiwan webinar because I have so many questions on Taiwan 2026 and also around the whole ecosystem of the supply chain recalibration. But we are running out of time. We have 12 minutes. We have like 8-10 questions, and we still have William who hasn't gone over it. So William, quick overview of the credit story, because then I have to talk to you about a bunch of questions on the crypto and digital ecosystem. Okay, so first, credit.
Yes, so there have been some questions that we received over US credit, given some high-profile defaults in the high-yield space. So our take is that they are not likely to pose systemic risk. The defaulted amount is quite small, but it's also at the same time that we are seeing default rates creeping higher. So I think what's interesting is, and this is the theme that we have in our credit section, between terrorists and valuations. So terrorists, by and large, are falling unevenly across different sectors. One of the worst hit sector in the US is the auto sector. So it's not necessarily a surprise that the high-profile defaults are happening in that space. But by and large, corporate earnings are up. Credit metrics are strong. So we still think, essentially, that the investment grade universe will still be quite resilient. So it's really a case of separate paths over here, where we could see slightly higher default risk in the high yield space, but the higher quality investment grade space will probably be a bit more resilient. In Asia, I think a lot of focus has been on China, particularly with regards to deleveraging efforts. So the Chinese government has embarked on debt swaps for LGFE. So a lot of LGFE debts have been swapped out into local government debt. So that's brought down a very significant amount of risk in the system. But of course, given that the leverage ratio is still very high in the private non-financial sector, there's still more room to go. So more quotas will have to be utilized in the coming years. So the quota for this year has already been fully utilized. But by and large, I think risks are diffused. The real estate sector, of course, still not really recovering yet, but the pace of decline in prices will likely slow from here. So that's likely on the margin to be somewhat supportive for the real estate credit sentiment. In the rest of Asia, valuations are very, very high. Spreads are pretty much at record lows right now. Part of it can be explained with the fact that supply is very constrained, but also at the same time, there's very little buffer, right, for credit at this moment. So by and large, we are probably going to be steering a bit on the cautious side and looking for opportunistic entry points in Asian space.
All right. Well, Young, I was going to follow up on credit, but I'm not going to because there are other things to cover. All right. So let me put up the first question on Pigeonhole. It's on Bitcoin. I think you can guess what the question is. The sustained bearish momentum. What does it signal about the long-term viability of Bitcoin and the broader crypto market?
So, I mean, Bitcoin has seen a large decline since 1010, right, when the Trump tariffs shook the market, created a huge cascade of liquidations, especially in the altcoin space. Sentiment is poor, but by and large, I think also the news flow around the policy implementation, around some of the legislative milestones that markets are looking forward to, that has been delayed. So we know Clarity Act probably is not going to be announced in the Senate this year. So they're still in the process of formulating the draft bill. So very likely, because of the government shutdown, we've seen a lot of time being wasted. The important Clarity Act will probably come in 2026. So the timeline is delayed. Sentiment, I think, has taken a bit of hit. On the China front, virtual asset front, there was initially a lot of excitement over Hong Kong, right? Because they're supposed to launch a stablecoin regime next year. But some of the excitement has, I think, been pared back, right? Because China has put out a very cautious stance on stablecoins. They're still wanting to be more on the experimental side. They're not willing to go too far in terms of releasing stablecoin licenses. So probably even if there's a dozen of applicants, maybe just 2 or 3 stablecoin licenses will be issued early next year. So that, I think, is also putting a bit of dampener in sentiment. But by and large, we still think that the takeoff in the crypto is real. The transactions being done on the crypto networks, all that's not going to disappear, even if sentiment is a bit weak. So for now, we think probably we could be reaching levels where there's some degree of bottoming.
Right. Now, so between you, Philip, and I think we all agree that the stablecoin developments are potentially consequential. They will not necessarily start disintermediating banks and payments immediately, but they do pose risk. We do feel the light touch regulation that the US is pursuing does entail some risk, but at the same time, the genie is basically out of the bottle and the disruption is coming whether we like it or not. I think BIS remains very worried about some of the implications of disintermediation that comes from stablecoins, but it is what it is, and we have to sort of deal with this thing. So I think we should share with you that, during our visit to the US last month, we talked to a lot of current and former regulators who all felt that the light touch approach toward stablecoin regulation could lead to governance lapses going forward. And if that were to happen, it would actually undermine the cause of stablecoins as opposed to reinforcing it. And to what extent the US remains sort of committed toward having very light touch on stablecoin could itself be a disservice to the asset class by itself. William, of course, you lead our projects on digital asset quarterlies and monthlies, so we'll look forward to your work on that. So thanks very much. A couple of housekeeping issues. So there was a question on where this PowerPoint slides would be available. You can reach out to your DBS sales representative. You can email us directly, or we might even put it up in our website. So there are 3 different ways of accessing those slides. Okay, this is a question that comes up all the time. We don't necessarily do a lot of covering of gold by ourselves, but we will get more into it. That is not the question. Let me put the gold question up. Anyway, even if I can't find it anymore, I think I had answered already in the clicking motion. On gold, the view is it reflects geopolitical risk premium. From 2020 onward, after the pandemic, the typical historical relationship between real interest rate and gold, which used to be a very tight relationship, completely broke down. And over the last couple of years, whether it is Russia's invasion of Ukraine or all the other things that have happened in the US, including Trump's reelection, have increased geopolitical risk, and gold has become a very key player in manifestation or expression of the geopolitical risk. It is not driven by retail demand. In fact, this high level of price of gold is destroying jewelry demand and retail demand both in India and China. It's just way too expensive. Ask any friend of yours who's in the jewelry business and you'll know. It is driven by financialization of gold. GLD as a gold ETF or various gold-related futures forwards are being traded heavily by institutional investors. That is the key driver of gold. That probably will not go away anytime soon, but any dissipation of geopolitical risk, any increase in real interest rate would probably play a detrimental role in the outlook for gold. The speculative part might have gone a bit too far. That's my personal view. Not particularly bullish gold going forward. You heard from Philip that we are not necessarily very constructive the US dollar, but we're not issuing a wholesale bearish call in the US either. And the value of gold is the flip side of that to a very large extent as well. Okay. Now this question I think involves both Eugene and Philip. So let's put that on the screen. How do you see US Treasury yield in 2026 and impact on dollar index in 2026? And then by extension, what will be the impact on US dollar Asian currency? So Eugene, you go first, and Philip, you take it.
Yeah, so I think the issue here with the yields, right, is that sometimes there's no clear trend, right? You look across 2025, you're looking at periods where we think, oh, the economy is going to fall over due to tariffs, and then at different points you have worries about inflation, worries about fiscal. But so if you look into 2026, then if you filter out all the noise that you want to pave a path, I think it's easier to go with, in the near term, there could be some downside risk to watch out for, because if you look at the alternative labor market indicators, they are pointing to a slowdown. And if the official data also turns out to be somewhat weak, then I think this slowdown worries would start to kick in. Right? Insofar as we think that this is a relatively minor kind of slowdown, then at some point in the second half of next year, we'll probably see yields start to rise again. So 10-year, many different factors. In terms of trajectory, we think it is down first before things stabilize, and then a rise towards the second half of next year.
Philip, a quick rejoinder to that.
Okay, binary. Basically, if Treasury reflects fiscal risk, negative dollar, good for Asian currencies. If it reflects resurgent inflation, and dollar is going to surprise on the upside, then there's going to be on Asian.
Fantastic. That's really, really good. Couple of big picture questions. Should Jamie Dimon's cockroach warning after the first brands and color bankruptcies in September be a red flag? Jamie Dimon is not a soothsayer. He is among many observers in the financial market. Yes, he is the CEO of the largest bank in America, but he has had many warnings in the past as well that has not borne out. So let's not necessarily use Jamie Dimon as the marker for the red flag. But having said all that, we have a stretch cycle, which has been supported by liquidity and a big tech super cycle, if you will. Risks are percolating in the private debt space, in the private equity space, at the subprime, no question about that. So we, like Jamie Dimon, are looking around the US economy for signs of red flag. But mind you, US household balance sheet has never been stronger on average. The debt GDP ratio is the longest in about 15 years, goes back to pre-GFC days. US households net worth has never been stronger on average because of the record rise in stock prices. There are parts of the US economy where wages are stagnant, where there's a lot of insecurity about jobs. But while the human cost of that is substantial, and there is a political implication around that, but there are political implications around that, on average, they are not economically that systemic. So that's the key issue. Unless we see at a large institutional level a major setback, we should not necessarily worry too much about sort of a house of cards type situation in the US. For me, it's the AI-related valuation and stock ownership and the disproportionate nature of valuation concentration that is the big risk for 2026. One final question I'll take, and I only take because there are 5 people who've upvoted this question. I didn't want to do it. Radhika, I went on a limb and said I was not comfortable with Indonesia outlook. I was thinking about you when I said that she may not like me saying this thing. So let me refrain from opining on Indonesia. You end this call for us with your top concerns on the Indonesia economy.
I think I wouldn't categorize it as yet. I think, but the change is certainly coming. I think the new government that has taken over late last year, we can see that the policy priorities have kind of changed. From a very defensive approach towards fiscal policy, we can see that loose purse strings are being loosened, but they're still trying to keep within mandatory thresholds, and I think that will be very important because part of the question that was asked is also what is one big key risk. When do you go too far? I think that's the question that the administration will face. But as of now, they seem to respect all the thresholds. They seem to be focusing more on implementation. But certainly for monetary policy as well as fiscal policy, I think there's going to be a predominantly growth supportive move. Inflation will matter, currency will matter, but I think to take growth from this 5% handle to a bit higher, 8% was spoken about, but I think 5.5, I think would do the trick. That's where the emphasis is going to be. But in terms of investments as well, I think there's this overall push to move away from being very commodity specific to downstreaming and manufacturing 101. I do hope that that's where the new focus will be as well. For the time being, it's much more welfare spending driven, so a bit of a bottom up approach. And if that really does help improve human capital, because productivity has been falling, so if it does improve human capital, I think that will provide a very durable support to overall growth. So our growth numbers are a bit optimistic for 5.2%. Decade long average is at about 5%. It hasn't really moved much. So we'll see if this kind of a bit more growth supportive role will translate into a slight improvement in the growth prospects. So more cuts expected from BI and slightly wider fiscal deficit expected going into 2026.
Thank you, Radhika, for your constructive and far more diplomatic than anything I would have managed in responding about Indonesia. That's it. We had other questions. We run out of time. Thanks, everyone, for joining in. We will be doing country by country annual outlook publications and webinars for the rest of the year. So watch out for those. Thanks for everybody joining in, and thanks for all your support. We do it for all of you, and we really enjoy doing these things. So until next time, everybody, stay safe, stay healthy. Thanks very much.